I don't want your account to look like SoFi did yesterday. Down nearly 12%. This stock is getting absolutely monkey hammered here. And because of that, I don't want this to happen to you. We are doing what I like to call Ask Me Anything Friday. Now, I have a huge list of questions from our viewers, and I'm going to answer them live and try and give you the very best responses that I possibly can to help you save time, make money, and start winning with less risk. Nate asks the question, is the new half ATR roll up rule from Scott Raff and back tested, or did it come from somewhere else? So Scott Raff was our intern over the summer, our quant intern. And on the plan M, this is a new rule that I put in place just the other day. And in fact, I believe it was maybe a week ago today. So plan M, the average trade days was 17 days. And over 7,000 trades, this has a 57% win rate, with the average trade return being 2.25%. Keep in mind, this is building losses into the plan. This builds losses into the plan. If you can't build losses into the plan, you don't have a plan. You have a hope and a dream. So losses are built into the plan 40%, 43% of the time. Yet the total on all trades combined was a 2.25% average gain. So to Nate's question, the half ATR roll up, when we do plan M, which we haven't done plan M yet, right? We've only been in plan ETF 3 times so far. The rest of the time we've been sitting in cash, not effing up our portfolios. The first half ATR gets a roll. The way that came from, Nate, was looking here. The winners on plan ETF had an average up move of 3 ATRs from the beginning of the trade to the highest peak of the trade, an average up move of 3 ATRs, with the average end being somewhere around 2.2. The losers had an average up move of 0.6. And then the average net result was down 1.38 ATRs. Now, when I was reading through this the other day, I was like, wait a minute here. At this first half ATR up in a trade, so imagine we buy SoFi here, and it goes up half an ATR. Okay, this is not advice. I'm just telling you, this is as an example. Let's say that we opened it here, and the current ATR value is 2.09. So if it goes up $1, that would be a half ATR. And so that would be 28.37, so 29.37 here. Okay, so imagine it goes up half of an ATR. That would be our first rolling point. Now, I want you to remember, at this point in the trade, we don't know if this is going to be a winning trade or a losing trade. This is still up in the air. We don't know. Okay. And because of that, we can't say, well, it's handicapping one and not the other. No. It is a defensive position, because when we roll, we're taking partial profits. We're keeping the trade alive, and we're freeing up capital that we can trade with something else. Because we don't know at the time of the first ATR getting hit if it will be a winner or loser, we are therefore helping both sides, both a winner or a loser, by taking cash off the table. So I think it's really cool. I think it's going to be a huge help for us as we work through these trading plans. RG2312 says, how do you take IV into account with the spread and options? Well, first, I don't do any spreads and options. I only trade long calls. And honestly, I don't know the next time I'll trade long puts. So I only trade long calls. Now, we're going to look at SoFi here just because it's pulled up. The implied volatility is going to change from week to week, day to day, stock to stock. The implied volatility is going to change. Implied volatility is basically it goes into the extrinsic value. Okay. Implied volatility goes into the extrinsic value. That is fallen into the Greek known as vega. Intrinsic value is the calculation between the current price and the strike price. So that will only be mathed out between the current price and the strike price will be intrinsic value. Extrinsic includes time value and vega, which is the implied volatility. And that implied volatility is basically building in more uncertainty, because remember, the extrinsic value is additional uncertainty. The closer you get to expiration, the closer that gets to zero. The further you get from expiration, the more extrinsic value will always pay every time, no matter what, because that's how options work. So looking at the extrinsic value here, that will inflate or deflate partially from vega, implied volatility, and partially from theta. And theta will decrease over time. Vega can expand or contract at the same time. So to RG's question here, how do you take it into consideration? I don't. Now you're probably like, wait, what? What do you mean you don't? I don't. Right? when I'm looking on an options chain, I basically look for the 80 delta, and then I look at what percent of the extrinsic value is of the total cost. Now, this is super wide. Let's go to something more liquid. Maybe AMD is more liquid. I don't know. Let's see. Hold tight, let it load in. There we go. Yeah, this is tighter. So I basically start at the 80 delta, and then I take the percentage of extrinsic value, 447 over 3280. 3280 is the ask price. That's what you're going to buy it for. And so 447 extrinsic value divided by 3280 gets me 13%. 13% of my option is extrinsic value. Now, if implied volatility has expanded and this is bigger, and I look at this and this comes out to like 33%, it's not that difficult. All you have to do is go deeper in the money. Because the deeper you go in the money, the less extrinsic value you're paying. So therefore, the less total percentage will decay. And that is part of my trading plan. Right, where is that at? Here. 30% is my absolute max on extrinsic value. My goal is hitting 20% or less, but absolutely no more than 30%. And because that is the uncertainty value that will decay over time. So you've probably, and based on this question, you've probably watched videos talking about how you need to sell options when implied volatility is high and buy options when implied volatility is low. The way that I trade, the way that outliers trade, is it doesn't matter. Oh, wait, I get to do it. Hold on. I get to do it. Hold tight. This is a gag that I'm going to start doing, right? The way that I look at it. Crap, hang on. I'm blowing it, but I'm still going to do it. The way that I trade is like this.
That's exactly. It doesn't matter what you think.
It doesn't matter how much extrinsic value there is, as long as it's under 30%, right? It doesn't matter how much the implied volatility is, because I'm going to account for it. Outliers are going to account for it. And it's as easy as moving up the street. So it's a great question, honestly. And I don't fault you for that question. But in reality, if all I'm doing is trying to base my trades on keeping as low extrinsic value as possible, and all I have to do is just move up the options chain, makes it super simple. Now, Rick has a great question. This is a brilliant question from Rick. Is the current trade a good trade or a bad trade? So for those of you who don't know, we are in plan ETF right now. And we're talking about this in Bravo class yesterday. Part of being a trader is understanding the acceptance of risk, right? When I put the trade on, I was accepting the fact that I had risk in the trade. Remember, all stocks are bad, but every once in a while they act right. So for this trade that I put on, right, I knew what I was getting into, and all I had to do was create a plan and therefore follow the plan. And right, it went down. Could I have done anything about this? Is there anything at all that Chris could have done to have prevented this? Until I get Nancy Pelosi's phone number, there's nothing, not a single thing that I could have done to prevent this. And I don't have to, because I accept the risk that comes along with trading stocks. If you can't accept the risk of any stock turning around, you should not be trading. So to Rick's question here, is it a good trade or a bad trade? And we discussed this yesterday in Outlier, right? You're probably thinking, or in Outlier Universe, you're probably thinking, well, clearly it's a bad trade, Chris. Absolutely not. Absolutely not. This is a good trade. And the reason that it's a good trade is because I had a plan to get in, I have a plan to get out, and I have no expectation on what the outcome will be between those 2 points. When you stop having the expectation of an outcome and you just follow your plan, the profits will automatically take care of themselves. But Chris, this trade isn't profitable. I understand. And we have built losses into the plan. And you need to, and Rick, I'm not speaking to you personally, I'm talking to those who are complaining. You've got to understand that even the very best traders in the world, this is from Mark Minervini, even the very best traders in the world have a skewed bell curve. And Mike, this is to answer your question too, have a skewed bell curve where the normal distribution is not normal. That is very similar to plan ETF right here, right? This is the higher this goes, the higher the frequency, right? So we can see we had some big winners, big giant winners, and then we had plenty of good sized winners. I call this moderate winners. We had lots of break evens to small losers, and that's it. Now, there are 4 types of trades: good trades, bad trades, winning trades, and losing trades. Good trades are trades that you can win on and lose on. A bad trade is one that you didn't have a plan and you just YOLO'd into it. You FOMO'd into it, right? I, as a fund manager, have a plan. And I get so frustrated, Rick, and it's not at you directly, but I get so frustrated because it's like these people expect me to deliver them trades that only go up. But Chris, you're a fund manager. Shouldn't you always have a 100% win rate? No. In fact, all of my data shows that that is an impossibility. But what this shows is the 4 types of outcomes that are 100% possible in every single trade, which is a big win over here, a small win over here, break even right here, and a small loss right here. Notice there are no big losses. So I don't understand why everybody is crying their faces off when this is part of the plan. Nothing has changed. Everything is following the plan exactly. But Rick, to your point, it's a great trade because I'm going to follow my plan. Is there any truth to making money with in the money covered calls? Now that's a weird thing. Now, Thomas, I don't know if this is a trade you make or not, but in the money covered calls are very weird to me. So let's do a covered call because I want to describe what a covered call is, right? First, you own the shares of stock. Open image in your tab. First, you own the shares of stock. Well, this is a big image today. You own the shares of stock, so it moves like this. You sell calls against that stock, so therefore you cap your gains. If you're doing an in the money covered call, that feels broken because first off, let's say you own the shares and you're selling an in the money covered call, so you're only going to take advantage of the extrinsic value. The extrinsic value is the only thing you will make money on if you sell a call, period. A covered call only makes money on the extrinsic value. So why sell it in the money? That feels like you've handicapped yourself. Like you've taken your trade out at the knees. I don't understand why anybody would do that. And then there's additional risk to that. And I know this sounds crazy, but there is actually additional risk to go along with this. Because with a covered call, let's say that you're in AMD and you sell the 280s, okay? You're selling the 280 calls for $4. You actually get the capital appreciation from 250 to 280. You get all of that juicy goodness. You get all of this move, this $30 move right here, you get all of that. And if it doesn't go over 280, you get all of that plus the $4. Even if it does go over 280, you get all of that plus the $4 you sold it for. But if you're doing in the money, you get no capital appreciation. You only get the extrinsic value. That's weird to me. I don't know why anybody would do this. But you know what? You do you. If that's your trading plan, I'm not going to tell you what it is. Explain the difference between the orange and blue bands. That's not a very polite way to ask, my friend. Explain the difference, Bruce. How dare you? How dare you give me something to do like that? I'm going to pop one open at random. So the orange and blue bands that he's talking about right here, these are order blocks built inside of Ovtlyr. And that's what filters into the order blocks over here out of the Ovtlyr 9. But looking at this, right, when I'm looking at these right here, I always want to confirm them on the trading view chart because sometimes Ovtlyr will pick up some that trading view doesn't, and trading view picks up some that Ovtlyr doesn't. I like to have that double confirmation, but that's all it is. That's the order blocks. Now, this is an area of resistance, overhead resistance right here. And you can see how it's fought through that area and has not been able to go through it and went down. And now it's created an area of support down here, which if it pulls back, it could help it with bouncing back up. These are areas of significant buying and selling activity. That's what it means. Jeff asks, which of the 5 market wizards that I worked with have you felt impacted you the most? So for those of you who don't know, who just think I'm a random guy on the internet, I've been trading for 16 years. I've made $4 in the market. And the market wizards, I've worked with 5 of them. They're the greatest traders of all time. There's Mark Minervini, Tom Basso, Larry Height, Jason Shapiro, and Jack Schwager. I would say the 2 that were the most impactful were obviously Mark Minervini and Larry Height. Those are the 2 that I talk about the most. Tom Basso, interestingly enough, was all about that trading psychology. Oh my gosh. His nickname is Mr. Serenity in trading. And if you want to know why I act the way that I do, it has a lot to do with the principles that I learned from Tom Basso, right? Larry Height, the things that he taught me were following the trends and man, using options and the leverage that comes along with those. Amazing work from Larry. Mark, I can't even put a finger on all the things that I learned from Mark. And then Tom Basso, just honestly all day, every day, that trading psychology, that laissez-faire, that flippant attitude to trading stocks of, I don't know what's going to happen. And I don't need to know what's going to happen. Because given enough trades, given enough data, this is how the back test performs. So therefore, the more opportunities I have, the more likely that this will happen. The more likely that this will happen, which is actually a really cool thing to think about, right? Kevin says, I heard you say do not use a stop loss on an option. Is it safe for me to assume that in your plan you do not use a stop loss on plan ETF? And for my plan, I want to use one. If I want to use one, I can. So Kevin, first off, always come up with your own rules, right? All I do is share my rules, right? And my rules are not going to fit everybody's personality. And I don't expect them to fit everyone's personality. My rules were built in a way that fit my personality with the data, and I'm very comfortable with running it. Now, I don't use stops on options because option prices can widen out bigly without even trying. Something that's, in this case, 65 cents wide could widen out to $1.65 and then contract into 25 cents, then widen out to $2.35 at different points during the same trading session. It can widen out like that. And then if you get your stop loss associated with the price of the option, right? I know a lot of people like the idea of putting like a 30% stop loss on the option just in case. Imagine that it widens out and the bid is so low it ticks your stop out point. The stock didn't hardly do anything, but the options widened out. And now you're out of the trade for nothing. You just lost for nothing. That's happened to me, which is why I will never put a stop order on an option, period, full stop. It's not going to happen. I want to manually be in control of that. And I think you should be as well. But is it safe to say you don't use a stop loss on plan ETF? These are my exit signals on plan ETF. If it does not fit one of these things, then I don't worry about it. And that is the type of attitude you have to develop as a trader. Is these are my entry signals, these are my exit signals. If nothing is hit, then I don't do anything. I don't sit there and sweat and lose sleep at night because I have position sized myself in a way where it's going to be what it's going to be. And until one of these things is hit, I don't do anything. But if you are losing sleep at night, you're trading too big. A great question though, Kevin. Nate, is there some sort of educational setup that explains everything that us poor traders could use to save time, make money, and start winning with less risk? Well, Nate, I'm glad you asked because Outlier University is happening right now.
Are you ready? Let's go!
Respect is earned. Respect is never given.
That is right. Every Tuesday and Thursday afternoon, we have a full class of students who are learning in Outlier University, right? I'm teaching them literally everything that I possibly have learned in the 16 years of trading and the time that I've made $4 in the market and working with all the market wizards that I have, right? I've come across an incredible amount of information that I want to share with you. Now, if you are an outlier, it is included as part of the 82 cents a day There is no additional cost to it, and it will be provided on YouTube as a replay for free, and it will live out on YouTube forever, right? I want you to be successful. Our job at Ovtlyr is to make money with you, not make money from you. So other people would charge you $12,000 for something like this, and we give it to you 100% free as part of the Ovtlyr package, which is literally just 82 cents a day. So great question. Really appreciate that. Lil even says, you always trade at the end of the day, except on emergency exits? Yeah, but that's my plan. That's my plan, right? These exit signals are all end of day exit signals, because that's how the data was built. Ooh, wait, what? Wait, what? The data that built this plan right here was all built on end of day closing price signals. So therefore, I don't need to do anything but trade at the end of the day. Now, there is a modification in plan M for a 3 ATR midday emergency exit. But the likelihood of that being hit is pretty low because the average trade exit is only 1.3 ATRs down. But when Scott and I were working on this plan and I looked at the biggest losers, I was like, all of them are greater than 3 ATRs. And there wasn't very many. There was only like 8 of the 7,000. I was like, I'm just going to put a 3 ATR max stop. And of course, that helped our overall results. So that is my only midday emergency exit. Rui asks, what is your opinion between the buy? Okay, let me see if I can read this correctly. What is your opinion between buy call on a short ETF or buy a put on the normal ETF? I got it. If the plan is to go short, of course. So if you were to buy a put, so let's use SPY, for example. If you were saying, okay, I think SPY is going to go down, so I'm going to take a bearish stance. So I'm going to buy a put on the SPY. Okay, that makes sense. Or if you were to go on a inverse ETF, buying a call because the inverse ETF would go up in value as the price of SPY would go down. I wouldn't overcomplicate it. Personally, I wouldn't overcomplicate it. If you're bearish on the thing, just buy a put. If you're bullish on the thing, I would just buy a call. Can you do either one? Yeah. And I mean, logically, what you're talking about makes sense, but I feel like it's adding a layer of complexity that you may not need. Stock Runner, can you talk about how the stock close price affects plans AM ETF plan analysis outside of the standard bullish setups? Examples, 10 over 20 price or 50, the price hit or cross below 10 or 20, any exit triggers? I mean, I'm not 100% sure of the question here, so I'm just gonna show you the exit signals, right? And this is part of the thing with Ovtlyr, right? We don't hold anything back at all. These are the plan exit signals. Now, of course, if you are trading something that doesn't fit plan M or plan A or plan ETF, that's fine, right? We still give you the sell signals. In fact, today we have 53 sell signals and 53 buys, or 56 sell signals, 53 buy signals. That's it. So plan M, a sell signal, a 10-20 bearish cross. If it runs into an Ovtlyr block that's at least 120 calendar days old. If there's earnings, I will close before earnings. A gap and crap where it goes up 5% and then comes down, 2 ATR stop loss, and a 3 ATR midday emergency exit, right? Plan A, similar but different. A close under, or I'm sorry, the sell signal and Ovtlyr, a close under the 10 EMA, an Ovtlyr block, earnings, or gap and crap. So there's a lot of crossover here. Plan ETF, sell signal, 10-20 bearish cross, an order block being hit, or close well above the 3 ATRs of the 20 EMA. I mean, these are actually significantly less, whatever plan you pick. And here's the other thing too, right? If you're going to trade a plan M, you have to follow the plan M entries and you have to follow the plan M exits. Or if you're gonna create the stock runner plan, you have to follow the stock runner entries and the stock runner exits. You're not allowed, and a lot of people do this, by the way, you're not allowed to say, okay, this is a planned stock runner entry. And then you turn around and you FOMO out of it, or you panic sell, and then you FOMO into something new. And then you're like, oh, wait a minute, I should follow that plan. No. The deal is that if you create a plan, if you backtest a plan, you got to follow the plan. Larry Height one of the market wizards, like I talked about earlier. Specifically, he and I talked about this, and I'll never forget this because he said, if you have a plan and you don't follow that plan, you might as well just crumple it and throw it out the window because you never had a plan to start with. Janine says, do you have an account set up like a business LLC for tax purposes so you can write off all expenses? I do have an LLC that I trade through. I'm not giving you any sort of tax advice. I would seek out the advice of a professional accountant. That's as far as I'm going to go with that. How to roll put options. I'm confused. I haven't even rolled a call option. Well, rolling is super cool, right? Rolling is where you're able to take partial profits, keep the trade alive, and free up capital to make new trades. So if you were to roll a call option, we'll start there and then we'll go to the puts. To rolling a call option, let's say that you own the 200s and it's gone great on AMD, and now you want to roll up. So what you would do is one order, you would sell to close the 200, then you would go closer to the money, and you can decide where that is. I mean, I'm going to look for liquidity. I'm going to look for my extrinsic value. I'm going to look for the bid-ask spread. And if I find one that I like, that's going to be the one. And it could be $20. It could be $5. It could be $2. That part is up to you. And I would focus more on liquidity than anything. And then you need to make sure that you're getting a credit. If you're not taking in a credit, you've done it wrong. Now, let's say you need to go out, right? Let's say that you're on this expiration and you're like, oh, you know, I've got the 220s here, but this is going to expire today. I got to do something with it. You can roll out in time. But if you do, you need to make sure that you roll for a credit, because if you roll from the 220 to the 220, it will cost a debit. Why? Because you have greater extrinsic value, right? You have 16 cents of extrinsic value today, and you have $1.76 extrinsic value for 1 week out. The intrinsic value will be identical, because remember, the intrinsic value is the difference between the current price and the strike price. So if you do same between expirations, it will cost you a debit. Do not do that. That increases your risk. It actually costs you money, and it does not help you. It gives you more time, but then it also gives you higher risk. So what you would do is you would go to the 220, and then you'd have to roll closer to the money, maybe to the 225, to the 230. Let's just do the 225 for round numbers here. And that takes in a credit of around $3.12 at the mid price. Pretty cool, right? Now, let's do that on the puts. Let's say that you bought a put and it's going great. And let's say you own the 270 puts. And so to do this, you would sell to close the 270 put and just do the same thing we did. You would go closer to the money. So from 270 maybe to like 260, and you buy that one. And you need to make sure that you're taking in a credit. In this case, I think I clicked it wrong. Hang on. Sell to close, buy to open. Should take in a, oh, I am doing it backwards. So I was doing the call side. Sell to close, buy to open. There we go. And you're taking a credit of $7.93 in this case. So therefore, you reduce your risk by $7.93. So it's the same as you do on the call side, just flipped onto the puts. That's all. You got it. You got this. Let's see. Steven says, someone posted a video about using collars as a free or cheap way to protect your trades. What is your opinion about collars? It's been a minute since I don't even remember what a collar is. Let me go look at it real quick. If I remember correctly, and I could be wrong, it is selling a put and buying a call simultaneously. Basically synthetic long stock. Let's do collar option. I could be wrong. Let's double check that. Long put, short call. Yeah, for the stock. Yeah, for the short call. So you're selling it. So you own the stock. You're selling a call against it, and you're buying a put. Oh, I see. So what you've done is you've taken a trade that was just long stock, and then you've wrapped it into a put credit spread, or really you're crossing both sides. This is useless. I don't see any reason to do that. Yes, you're going to get some credit from selling the short call, but then you're going to pay a debit to get the long put. I don't understand how that would help you at all. A protective collar. Yeah, you're limiting your you're limiting your losses for sure, but you're also kneecapping your gains. That's not something that I would do. That's not something I would do. But however, Stephen, my friend, if that works for you, then do that. I'm a big believer of letting your winners run out of control and cutting your losers short. And by doing this particular trade here, you're capping your winners just like you'd be capping your losers. And I don't think that that is the best thing to do. Richard, great question here. What are the top 5 trading books I recommend? This is an easy question. We're going to end on this one. Number 1, Trend Following by Michael Covell. If you can get the 2004 version, do so. This is the best $10 I ever spent in my life, hands down, full stop, not even close. The 2004 version is half the size of this version, which I think is the 2012 version. And it's such an easier read, such an easier read. So again, if you can get the 2004 version, get that one. Next, so that's one. Next is the Complete Turtle Traders. This is what we're doing in Outlier University, which is teaching people who, a lot of people haven't traded before. And so we're developing Outlier University with the beginner's mindset in place, but to take you from beginner to expert following a set of rules, right? Now, Richard Dennis, the person who did the Complete Turtle Trader, both of these were written by Michael Covell, by the way. He basically said, I can teach anybody to be successful. The difference in somebody who's successful and everybody else is having the consistency and discipline to follow a set of rules. Now, as I mentioned at the beginning of this, right? Most of you guys can't do that. It's just a fact. That's normal. If you can have the consistency and discipline to follow a back-tested, proven set of rules, you can have abnormal returns. But you have to understand that every trade has risks associated with it. And if you cannot accept the risk of the trade, you shouldn't be trading it. Period, full stop. I don't have any sympathy for you at all. Next would be Trading in the Zone. This is the Bible for trading psychology, right? If you want to listen to what I'm talking about, read this book and you're going to hear the words from this book coming out of my mouth. One of the things we talk about is not setting expectations on the outcome of any trade, because any trade individually has a random chance of being a winner or a loser, right? Any trade individually can fall into the winning side or the losing side. And this is why I really like this this chart here. We're going to be using this quite a lot, because any trade individually can fall as a winner or loser. But given enough occurrences, you should have big wins, small wins, break evens, and small losses, right? And it would fit this curve given enough occurrences. And that's the thing I'm trying to get across here, right? Is any one trade can be a winner or loser, but given enough trades, you should come out ahead, mathematically speaking, right? And of course, no guarantee. So I'm not making any sort of income claims there. So that's 3 books. This one, How I Made $2 Million in the Stock Market by Nicholas Darvis, updated by my friend Steve Burns. Steve Burns was one of my mentors as well. And I love this book so much. It reads so easy. And Nicholas Darvis, who made $2 million in the stock market, was doing this around the world. His literal day job was dancing. Like, he would go on stage and shake his booty, and he made $2 million in the 1950s by trading by telegraph. I've never even seen a telegraph before, but bro made $2 million. Do you know how he did it? It's honestly simpler than you think. Hear me out. He would buy stocks as they're crashing up. It's crazy. And once they stopped going up, he would sell them. Oh my gosh, that's amazing. And he would buy all the stocks in a sector that's working. He would buy all the stocks in that sector, and then he'd just pick them off one by one once they stopped working. And then he would let the winners run as far as they possibly could. And once they stopped running, he wouldn't own them anymore. It's so simple. It's so brilliant. And that is literally the secret to the stock market. Buy stocks as they're crashing up. There you go. That's everything you need to know right there. Final one is New Trader, Rich Trader, also written by Steve Burns. A lot of people think that I'm the new trader in this book because Steve Burns was a mentor of mine. This is a brilliant read. This is my #1 book. If I were to give to anybody on how to trade, it would be this, right? If you've never traded before, or if you have traded for years and you're still not finding success, this is the book to get you started. Okay. So those are my top 5 books. Now listen, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day. We'll talk soon.